In 2025, the investment landscape is more dynamic than ever with cryptocurrency and traditional assets vying for the attention of both seasoned investors and curious newcomers. While crypto promises innovation, decentralization, and high potential returns, traditional investing offers stability, regulation, and time-tested growth. With evolving technology, shifting market conditions, and increased regulatory clarity, choosing the right strategy is more complex and more critical than ever. Today, we will talk about cryptocurrency versus traditional investing. What's better in 2025? So, before we start, make sure to hit the like button and subscribe to my channel. Understanding the basics. Traditional investing includes assets like stocks, bonds, mutual funds, ETFs, exchange-traded funds, real estate, and other government-regulated securities. These instruments are deeply rooted in centuries of financial history and are governed by established institutions, regulatory bodies like the SEC in the US, and monetary policy mechanisms. Traditional investing emphasizes long-term growth, portfolio diversification, dividends, and predictable performance aligned with macroeconomic fundamentals. Cryptocurrency investing, on the other hand, involves digital assets like Bitcoin, Ethereum, Solana, Cardano, and thousands of other altcoins. These assets operate on decentralized blockchain technology, which removes the need for central banks or institutions to verify transactions. While crypto was once viewed as a speculative and fringe asset class, it has grown significantly over the last decade and now attracts institutional investors, tech-savvy individuals, and financial pioneers looking for alternative returns. Volatility and risk. Volatility is a major differentiator between cryptocurrency and traditional investing. Cryptocurrencies remain highly volatile in 2025, despite growing adoption. Price swings of 10% to 30% in a single day are not uncommon, especially for lesser-known tokens. Bitcoin and Ethereum have stabilized somewhat compared to earlier years, but are still far more volatile than traditional assets like blue-chip stocks or government bonds. Traditional investments, particularly large-cap stocks, index funds, and bonds, offer significantly more stability. While markets can dip due to economic downturns or global events, they rarely experience the extreme, unpredictable price movements seen in crypto. For investors with a lower risk tolerance, traditional investments remain the safer route, particularly for retirement accounts or those seeking consistent returns. Regulation and security. In 2025, one of the biggest shifts in cryptocurrency is the growing presence of regulatory oversight. Governments around the world, including the US, European Union, and major Asian markets, have introduced tighter laws governing digital assets. This includes KYC laws, anti-money laundering protocols, and taxation requirements. These regulations have helped reduce fraud and create a more secure environment, but they also reduce some of the anonymity and freedom that originally drew many to crypto. Traditional investments are highly regulated and secure with robust consumer protections. Financial institutions are subject to auditing and investor accounts are insured, e.g. SIPC insurance and brokerage accounts. While no investment is without risk, the security frameworks for traditional assets are time-tested and significantly more robust. Returns and growth potential. When it comes to potential returns, the cryptocurrency has historically outperformed most traditional investments over short periods, especially during bull markets. Bitcoin's meteoric rise from a few cents to over $60,000 and beyond in some speculative forecasts for 2025 is unmatched by traditional equities. Emerging altcoins have also offered explosive growth, albeit with high risk. Accessibility and entry barriers. Cryptocurrency shines in terms of accessibility. Anyone with a smartphone and internet connection can open a wallet and start investing, often with as little as $1. Many platforms are open 24/7, offering global trading access without the need for intermediaries. This makes crypto particularly appealing to underbanked populations and those in regions with limited access to traditional finance. Technology and innovation. One of crypto's biggest advantages is its tie to cutting-edge technology. Decentralized finance, DeFi, smart contracts, NFTs, and blockchain innovations continue to disrupt traditional finance. In 2025, we're seeing real-world utility emerge, including decentralized lending, tokenized assets, like real estate and art, and blockchain-based identity systems. Investors drawn to technological progress and the potential for groundbreaking applications may find the crypto space intellectually and financially rewarding. Traditional investing also embraces technology, but at a slower pace. Robo-advisors, algorithmic trading, and AI-enhanced portfolios are now common, but these innovations operate within established financial frameworks. The adoption rate of disruptive tech is slower due to regulatory compliance and risk mitigation, diversification, and portfolio balance. Financial advisors in 2025 increasingly recommend blending both asset classes. Cryptocurrency, while volatile, can add diversification to a traditional portfolio due to its lower correlation with conventional assets. A well-balanced strategy may include a small percentage of cryptocurrency, typically 1% to 10% depending on risk tolerance, alongside stocks, bonds, real estate, and cash equivalents. This approach maximizes return potential while mitigating risk. Tax implications. Tax treatment differs significantly. In 2025, most governments now consider cryptocurrency as taxable property, meaning you must report capital gains and losses just like with stocks. However, the decentralized nature of crypto makes tracking and compliance more complicated. Many retail investors are unaware of their tax obligations, leading to surprises at tax time. Traditional investments are typically easier to manage tax-wise, especially when held in tax-advantaged accounts like IRAs and 401ks. Tools and statements from brokerages make filing taxes more straightforward. However, both types of investments require careful record-keeping and, ideally, consultation with a tax professional. Psychological and behavioral factors. Investor psychology plays a major role in both markets. Crypto investing often triggers emotional decision-making due to its 24/7 nature and extreme price swings. FOMO, fear of missing out, and panic selling are common, especially among new investors who may lack the discipline to stick to long-term plans. Traditional investing benefits from decades of research on behavioral finance, and platforms often incorporate tools to reduce panic selling or knee-jerk decisions. Index investing, dollar-cost averaging, and retirement planning are built to encourage long-term thinking and reduce emotional trading. Income generation. Traditional investments offer income through dividends, bond yields, and rental income in real estate. This makes them ideal for retirement strategies or passive income portfolios. Cryptocurrency is largely speculative and does not generate income in the same way, though innovations like staking, yield farming, and crypto lending platforms, e.g., Aave Compound, allow some investors to earn interest on holdings. These methods, however, come with risks, including smart contract vulnerabilities and platform insolvency. Environmental and ethical considerations. Another dimension in 2025 is the environmental and ethical impact of investment choices. Cryptocurrencies, particularly Bitcoin, have been criticized for their high energy consumption. Though the industry is rapidly shifting toward proof-of-stake, POS, and green mining initiatives, Ethereum's full transition to POS has inspired other chains to follow suit. Traditional investments also face ESG scrutiny. Investors can now choose from socially responsible ETFs and mutual funds that align with ethical values. While both sectors offer ethical investment paths, crypto still lags behind in providing comprehensive ESG-aligned options. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.